Okay, so you should be able to see my screen now. Um, just as a reminder, again, we do have our second test that's opening up on Wednesday, just like last time. It'll open up midday Wednesday and it will close on Sunday night. You will need to use the Respondus lockdown browser and monitor, so make sure that your computer is updated and you have the ability to do that. Um, and I would highly, highly recommend that you review the test study sheet. And I'm going to take, just like I did on the first test, I'm going to take the short answer questions and the essay questions directly from this study sheet. And this test is more challenging than our first exam. And one of the main reasons that is because we're building on what we learned in the first on the first exam. You know, you have the first four chapters. It's sort of an introduction to strategy, and now we're building on that and going through the entire strategy process and developing corporate strategy, and then leading into business level strategy and functional strategy. So that's going to be a little more complex. We also have the section on financial spreadsheet analysis, and I don't want you to memorize formulas. You won't be asked to calculate, the net profit margin. You won't be asked to calculate any financials on this, but you will need to know what it means. So, for example, you need to know that net profit margin will always be smaller than gross profit margin. Why? Because gross profit margin does not include operating expenses. Net profit margin, from your gross profit margin, you have to subtract your operating expenses to get your net profit margin, which is what you take to the bank. All right, that's the bottom line. In your simulation, the net profit margin is what you see on the fast track report. The very first line, when you see the selected financial ratio, says ROS, return on sales. That's your net profit margin. Another term for net profit margin is return on sales. Net profit margin, return on sales. So the very first line where you see some of you have 6, 7, 8% net profit margin right now, that's not bad at all, especially for the second round. But we're always comparing. Is it good or is it bad? Well, it depends, is the answer to that question. Is 7% net profit margin in round two good? It depends. What does it depend on? Well, look at your past history. Is it going up or going down? Number two, look at your competitors. How do you compare to your competitors? Are you better than or worse off than your competitors? And again, we're looking at net profit margin in the long term. We're making strategy decisions in the long term, not short term. So round two, you're still trying to get your footing here. You're still trying to deliver your long-term strategy. I wouldn't put too much weight on your performance in round two, not yet. I would make sure that you're making a profit, bottom line. If you're losing money, your business model doesn't work and you need to do some serious tweaking to your strategy. But as long as you're making a profit and you feel like you're investing in the right areas, by rounds 3 and 4, you should be able to see the return on your investment. So long term, that's what we talk about strategic management and business classes, because we're really focusing on the long term. We're trying to get businesses to not focus so much just on the short-term financials, which American companies tend to do. We want to focus more on long-term competitiveness. So that's why we've developed the balanced scorecard, so that it forces you to measure the effectiveness of your strategy, not just on your financials, but also your internal business processes, your customer, and your human resources as well. So that's the 4 areas of the balanced scorecard. And that's why we use that, because we want to put an equal emphasis on the strategic investments along with the things that you're doing that make your financials better as well. In the long term, if you're managing your business well, then your profits should go up in the long term. If we're investing in the right areas, your profits should increase in the long term. So we're always thinking long term with that. I would highly encourage you to watch the test two study sheet review. I posted another review like I did for the first test. This review will go through the questions I tend to ask on the exam and how to answer them. So take the 42 minutes to watch this test to review before you start the test. I highly recommend it. This is a closed book exam. And again, we will go through financial spreadsheet analysis, but just the basics. I'm not going to ask you to compute things, but I will ask you if higher is better or if lower is better generally when you look at a particular financial ratio. So usually if long-term debt is in the numerator, the lower the better. We want our debt ratios to go down, not up, generally speaking. For our profit ratios, higher is better. We want more profit. So if your profit ratios are going up, that's of course a good thing. So do put some time in preparing for the second exam. I want everybody to do well on it so that you don't have so much stress going into the last part of this semester. All right. So I have a lot of resources there that you can use to help you study. One thing I did notice before I signed on to the teams meeting this week is that not everyone has even delegated yet. I have 7 teams that have posted who's responsible for what in the team private discussion board. And that worries me, so only 7 teams have posted their responsibilities. So we need to do that. And you need to give each teammate, tell everyone, here's the interim due date for each person to have their part in, and it should be well before April 5. So you have time to clean it up, put it all together and clean it up so that it is all one paper. So that means we have 5 teams that have not turned in their breakdown, and I will send an email to those 5 teams and notify them that they're behind schedule with that. Hopefully they have discussed it and they have assigned responsibilities. Maybe they just missed that deadline because of spring break. So this is what's coming up due. Let's just take a quick look we'll see where the teams stand right now in the simulation. Let's take a quick look at that. And by the way, we won't be covering any new material this week because of the test. We really want to focus on preparing for the test and then working on your team SWOT and also your team CAPSIM simulation decisions. So let's go here and see where everybody is on that. Okay. My screen worked out here. Okay, so remember, we have 12 teams, so that means we have 2 industries going. And this is industry 1. If you're not sure if you're in industry 1 or 2, here are the teams in industry 1. You want to take a quick look to see if you're in industry 1. I can see industry 1 is pretty competitive in terms of financials. It looks like for round 2, that team Erie had the highest short-term profit. Let's just see what happened with our balanced scorecard for industry 1, see where how everybody scored. And you can see that our team leader currently in industry 1 is team Erie, and that's followed pretty closely by team Digby. All right. And then in 3rd place is team Chester. One of the things that I'm very pleased to see with all except 1 team improve their score. So if your score actually went down, if you're a team where your score actually went down, you want to try to figure out what happened. What are your weaknesses? Now, one of the first things you're going to do is, if you're not pleased with your round 2 score, is to look to see where your weaknesses are. And we're going to look at the fast track report to see in each of the two segments, where our products are lagging behind compared to our competitors. That's not to mean that you would want to copy the first place competitor, because that may not work out the same way for your company. But you do want to take some best practices. You want to look at what their product criteria are, their, the size and performance and the reliability and their price point, and see where you might be lacking, that your competitive position might be less. It could be that you stocked out. So when I look at the industry results, I'm going to look at the report, and I'm going to look at the fast track report here. And let's take a look at round 2, see what happened. Again, I see some really healthy return on sale. This is your net profit margin for most of the companies. That looks really good, but that alone is not enough to put you in first place, as you know. Everybody is making a profit. That's also a good sign. None of the companies in industry 1 had an emergency loan. That's a good sign. It means that you're managing your cash well. Our production capacity utilization, for the most part, looks good. One of the issues I see for industry 1 is that just about everybody stocked out. Every team stocked out. So maybe we're being just a little bit too conservative in our production capacity and are actually producing enough to keep from stocking out. Keep in mind that if one company stocks out, it could cause all the other companies to stock out, because you can see Chester stocked out. This is the potential. This is the actual. The yellow bar is the actual. Chester could have sold a lot more, and this is their cake product that could have been the #1 seller, but problem is not enough of cake was produced. And so customers still need the product. They're going to buy the product. So what happens is what Chester could have sold is now given to Chester's competitors. So if you're not producing a little bit more than what you forecast, then you're going to run out as well. All right. You'll get hit with a stock out as well. #1. And #2, you might stock out because you underestimated your own demand. So there are reasons why you want to produce more than what your marketing forecast actually is. So when you calculate your marketing forecast, just understand that on your production page, you're going to produce a little bit more. How much more? Maybe 10-15% more. And you might, if you stock out a lot, you might go up to 20% more than what you actually forecasted. The same thing happened in the high-tech segment. This time it's Team Digby that underestimated. Team Digby, that's your day's product. You could have been the #1 seller. You could have sold significantly more there. And instead, those sales were given to your competitors. So do consider that when you are entering your production amount. You're limited in the fact that, you do have a first shift capacity. You can run 2 full shifts, yes, but you are limited in your production capacity. But if you are running out of production capacity, it only takes 1 round to buy new capacity. So keep that in mind. So that's industry 1. Let's look at industry 2. And industry 2 as well. Everybody made a profit. That's a good sign. But it looks like there are some competitors who are doing quite a bit better than others. So just looking at it from a profits financial standpoint, it looks like we have 3 competitors who are doing really well. And again, this is the industry 2 teams. You can see who all's in industry 2. Let's take a look at the balanced scorecard for industry 2 and see what's going on there. And you can see here that for industry 2, it just so happens that it's also Team Erie that's in first place for industry 2. Right behind Team Erie is Team Baldwin, and then in third place, right behind them, that is Team Ferris. So Baldwin, Erie, and Ferris are doing really well. You see it's a little bit, all across the board here. Most teams did improve, but there are some teams that actually went down. And if you're one of the teams that your score actually went down from round 1 to round 2, again, look at what your weaknesses are, what happened. And it might be that your competitors made some dramatic changes in their marketing strategy or in their product design strategy. So look to see what your weaknesses are. Let's just take a quick look at the report and see what's happening there. Going to look at round 2, the fast track report. Everybody has access to this. And you can see that the net profit margins are a little bit tighter, a little bit smaller in industry 2. So we want to get a hold of that. We don't want to go into the negatives, definitely. So that could mean that you're spending too much money, or maybe your prices are too low. We'll have to take a look at that for each segment. A good sign is that, again, nobody had an emergency loan, so you're managing your cash well there. Your production capacity utilization overall looks good. When we did have too many stockouts, and how do I know that? Well, look at all the zeros. So here again, too many people are stocking out. And so what we might need to do is look at our inventories and produce more than what you forecasted, so that if another team stocks out, you can capitalize on that, getting some of their sales without you stocking out as well. So let's see if we can get a handle on our stock outs here, so we don't have so many of them. That's lost sales. That's lost potential sales, so it's an opportunity cost, and we don't want that to happen. We're being really conservative in terms of what we're producing. On the one hand, that's a good thing because we're reducing our inventory carrying cost. But on the other hand, it's a bad thing because we're losing customers, we're losing potential sales because we just simply don't have the product on the shelf that we need. So y'all watch your stock outs for round 3. Round 3, we will have the ability to do TQM, but always remember that after you make your TQM decisions, go back to your finance. Your finance menu should always be last, even though the TQM decision menu is listed last in the decisions menus. You do want to enter your TQM decisions. Go back and double check your finance page to make sure you have enough ending cash balance. All right, to get through the next year, you want that to be positive. And generally, you want your ending cash balance to be about 5 to 10% of your total revenues each round. Why? Because you're giving yourself some leeway to make a forecasting error. So if your forecast is too high or too low on your marketing page, the forecast that you enter, especially if it's too high, if it's too optimistic, you could run out of money and get an emergency loan, which we haven't had those yet. But we tend to see them as we go through these rounds. At least one company will have an emergency loan. We want to try to avoid that because emergency loans will lower your credit rating and increase your interest rates for future loans. So let's try not to get an emergency loan. Let's try to avoid them by having an ending cash balance that's sufficient enough to carry us through the entire year, and give yourself some room to make an error on your marketing forecast. So have 5 to 10% of your potential revenues in your ending cash balance after you have entered your TQM decisions, right? Guys, any questions about the simulation, about the team SWOT? Any questions about how to look up the information you need for your team SWOT? I think we talked about that before the spring break. Okay, I am going to stop sharing at this point. I'm also going to stop the recording. All right.